Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I am Paul Winkler, talking about that money topic. Yes. There is, I'm going to try to cram a bunch into this hour. We got some interesting stuff coming up. Money personality talk is going to be one, and that's kind of a fun topic. Ira Work is going to join me with that one. For some other things that we have on the plate to talk about, some good interesting stuff that we'll be covering in the second, third hour. But I'm going solo on this hour. Going to talk about some things that are on my mind, and there's plenty on my mind. One thing I want to do is I want to cover something. I want to talk about some data. Because we've been hearing talk about market volatility. As I always say, nobody worries about upside volatility. It's always downside volatility that eats people's lunch. Upside volatility, no problem at all. But, it comes with the territory. I like what Michael DeJourno always says. He talks about, he goes, don't let a temporary period of difficulty, screw up your long-term plans, because good times are coming, and they always are as we go through these cycles. But it's hard to see them when you're going through it. So I want to talk a little bit about periods of time, because we got the recent headlines on inflation, inflation higher, and we're hearing this over and over, the drumbeat of worst inflation in 40 years. That's what people keep talking about, right? Worst inflation numbers, difficulties, challenges. And, you think about it, it's okay, go back 40 years, and it just literally, where are we? We're back in the 1980s, early 1980s. So what I thought I would just talk about is a little bit about what was going on at that point in time, and a little bit of data from that point in time. So in September, I pulled up quarterly data on various areas of the market, various asset classes, as we call them. So you have large U.S. stocks. When we talk about the market on this show, it's a lot more broad than when you hear it talked about elsewhere in the media. Typically the market to the media to even the financial community, which should be a lot more sophisticated than they are, they just large U.S. stocks or total market. And you look at the total market indexes versus the S&P 500, you don't see much difference, or the Dow or the NASDAQ. That's all you ever hear talked about are those things. And I like to talk about market segments like large U.S. stocks and value. And sometimes you hear about value, and the value that is talked about is very different from what I'm talking about. A lot of times when you hear Wall Street talk about value, they're looking at companies that they consider to be undervalued, quote unquote, or they're looking at price to earnings ratios only. And price to book is really what I like to look at. That's what Fama, the Nobel Prize winning economist that coined the term value, actually looked at. So I think that's probably what I'm going to look at as well. And small U.S. stocks would be the 20% smallest companies on the New York Stock Exchange, all like-sized companies on other exchanges, which would be called the CRSP 910, Center for Research and Securities Prices. And then Fama French, the guy that won the Nobel again, and French, he's a Dartmouth guy. They both have indexes together, small research indexes, small value and large value research indexes. And then you've got international large companies, international small companies. And those are basic asset categories, the 6 categories that I'll talk about. But if you look back at the last time that we had inflation numbers that were akin to what we're seeing right now, and you look at the last quarter of 1981, which is, you look at inflation for the whole year, and there was a lot of talk, a lot of media coverage on inflation toward the end of the year. So that's why I'm choosing that particular period of time. A lot of talk about that in the second quarter, going into the third quarter of 1981. And if you look at large U.S. stocks, that one quarter, just a 3-month period, large U.S. stocks dropped a little bit over 10%. Now, there were several other periods of time before that they didn't have a great return as well. They had negative returns. But I want to focus on that one because that was the worst quarter, which is where they were talking about inflation the most at the point in time. Large value stocks down as measured by that indice that I was talking about, 4.79% negative return. Small companies, those crisp 9 to 10 that I was talking about, 18% negative return. 18%. 1 quarter, 3 months. Then you had small value stocks, about 11%. So you see that market downturns aren't that unusual, right? Large international stocks down 11.5%, small international stocks down 6%. So you had some dissimilar price movement where things moved in different ways and had, they didn't move down at the same degree is really what I'm talking about right there. Now, if we walk through the decade of the 80s, let's just walk through the decade of the 80s because we're talking about a period of time at the very, very beginning of the 1980s that there was a lot of stuff going on in regards to inflation, economic problems, inflation being called stagflation back then because of stagnant economy going along with inflation, which wasn't supposed to be able to happen. Typically inflation is going to be where you have prices going up, and typically where you have prices going up is where there's excess demand, and therefore what happens is you don't have the ability to produce. You don't have the numbers of people to produce, so the wages go up and prices go up, and then you had oil prices and you had fuel issues and trying to get transportation and those types of things. There were a lot of things that were causing inflation to go up, but the economy wasn't necessarily that great. So they say, right? So that's what was talked about at that point in time. That was the narrative. Now, if we look at the decade of the 80s as a whole, from 1980, January of 1980 through 12/31 in 1989, that whole period of time, rather than give you rates of return, because sometimes people just don't necessarily, it just doesn't compute with them. You look at the growth of $1, and you had about a 5-fold growth in the S&P 500 during that period of time, just a little bit over 5-fold. If you look at large value stocks, it's a little bit over 6-fold. $6 grew to $6.41. If you look at the growth of small companies, the crisp 9 and 10, it a little bit over tripled. If you look at small U.S. value stocks, that was a 7-fold increase. And just kind of wrap your brain around a 7-fold increase in value. It's just like, whoa, wait a minute, because you've always heard me talk about how inflation and stocks, stocks protect against inflation. And you hear people go, I'm going to get out of stocks. Oh my goodness. Oh my God, we got inflation. I got to get out. And I'm like, okay, what are you going to get into? CDs. Well, what's the one thing that never has protected you against inflation? The very thing that or annuities. I'm going to go to the thing that can't protect me against inflation. Whereas, equities, we often, and I've often, and it's funny because I hear my words parroted back to me by people. And they come in the office and go, yeah, I know that, in the short run, stocks can go down with inflation, but, long run, it's the biggest protector against inflation because inflation's prices going up and companies are raising prices and you own companies when you own stocks. And I go, good, you're hearing the message. Because the more I can educate, the more I can get you to understand how this stuff works and not expect things are going to be rosy all the time and just put up with the idea that it's just the stuff that happens, then you don't worry about it and then you don't get taken down the road. Now, international large stocks over that same decade, about an 8-fold increase. If you look at small international stocks, almost a 13-fold increase. 13 times your money at the end of the decade. And just wrap your brain around that for a second and go, okay, so what was being said, though, however, during that period in time? What was being said in the media? Well, I went through Trevecca's, their website for the library. As a student there, I get access to that. Thank you, Trevecca. And I looked back at the headlines back at that point in time, in very early 90s. One of the first ones, I just put inflation in there. And one of the first articles that pops up is this: Reaganomics. Why isn't Wall Street convinced? Why isn't Wall Street convinced? And they said, well, there are 4 things going on here. First, the economy is incorrectly perceived as brittle when actually it has good momentum. Okay, so you look at that and go, okay, so the economy, remember I said earlier that it was perceived that the economy was really bad. That was the narrative, right? But they're saying here, not necessarily, it may be incorrectly perceived. And it's funny because things are relative, aren't they? And we hear, that on one side, we hear, in one political party, we hear that the economy's great. The other side, no, the economy's terrible. And of course, you're going to have the one that wants to get reelected say the economy's great, and the one that doesn't want the reelection to occur in the other party's favor say it's terrible. But things are relative, and it's interesting because I went and pulled some data from The Economist, and lo and behold, this is interesting. If you look at the last year, according to The Economist, the most recent issue of The Economist, which is the June 4th issue of The Economist, they'll come out with one again right now, but this is this last week's. It says, so they looked at gross domestic product gains over the last calendar year. United States, 3.5% economic growth. Well, you look at that and you go, hey, you could make a case that's pretty decent. But like I said, everything's relative, right? Now, I don't get into politics here, but I'm almost going to have to sort of get kind of almost political, but not really in this, because I just want you to hear the relative numbers. China was 4.8. Great Britain, 8.7. 8.7. We're 3.5. 8.7. You look at the Euro area, 5.1. Austria, 5.5. Belgium, 4.9. France, 4.5. Germany. You would think that none of these countries are having any success based on what you hear typically in the media about them. France, 4.5. Germany, 3.8. Greece, 7.4. All of these are above the 3.5. Italy, 6.2. Netherlands, 7.0. Spain, 5.5. Czech Republic, 5.1. Denmark, 6.6. Norway, 4.8. Poland, 9.4. Russia, hey, we found one we're even with. Up to the point of the war anyway. This is data from the past calendar year. So the war's been going on, 100 days or something, a little bit over 100 days. So, it's probably going to come in worse than this later on. But I just thought it was just kind of funny. Switzerland, 4.4. Turkey, 7.3. India, 4.1. Malaysia, 5.0. Malaysia. Pakistan, 6.2. Philippines, 8.3. Argentina, 8.6. Isn't that interesting? Colombia. I wonder what they're producing in Colombia. Right, Ludwig? 8.2. 8.3 in Egypt and 9.6 in Israel. Okay, so you look at that and go, whoa, wait a minute. That's interesting. But back then, it was maybe the same thing was going on, because if you look at international stocks over the ensuing decade, international stocks did better as I read those numbers off. So it may be that just relatively we weren't doing as well back then. But remember, this was when Reagan was early on in his presidency. And they said that, number one, that the economy is incorrectly perceived as brittle. And it was going up. So in essence, it had good momentum. And they said that. So they said, second, inflation is not. This is interesting. This is 1981. This is when all of this information about the inflation rates, remember, we're going back and saying that we got the highest inflation right now in 40 years. Back then, what are they saying about inflation right now? We're not going to solve this anytime soon. It's going to be a long time. And, I just kind of put my hands in and go, I don't know. I don't predict the future. I have never found it to be a helpful exercise as an investor because it doesn't work. You can't do it. You've got to be able to predict not only what's going on in the economy, what companies are going to do, how they're going to respond, how governments are going to respond, how people are going to respond. Are they going to spend? Are they not going to spend? Are they going to hide? Are they not going to hide? Is China going to open back up? Is something going to be resolved over in Russia? I don't know that. I can't do it. I can't do it. But they said here 40 years ago, second, inflation, because remember, this is why Wall Street wasn't convinced about Reaganomics. Second, inflation is not about to be resolved. Because they were just basically saying some of his things that he was doing. And they had really rational reasons why it wasn't going to be resolved in this article. I won't get into them, but it's, they had some pretty rational reasons that made sense, from a logical standpoint. Third, fiscal policy will continue to be expansionary. Fourth, a great burden will be placed on monetary policy. What are we talking about all the time right now? Monetary policy and on the financial markets. A great burden. So therefore, it isn't going to work, right? Well, it sort of did work, didn't it? It sort of did. And it wasn't the only headline in all of this stuff that I'm talking about. I just went a little bit further down. Stocks weather first half well. Because remember what I just said, how difficult the returns were in 1981 in that fourth quarter. I mean, really bad, right? Well, what were they saying was likely to happen before that fourth quarter? Headline, stocks weather first half well. Look good for the rest of the year. Oops. Really blew that one. And inside, you'll like this one because we're talking about housing prices, right? A lot right now. An inside look at why housing prices are so high. Isn't that interesting that in the first part of the 1980s, when inflation rates were really high, mortgage rates were really, really high, interest rates were, just jumping up, and you had to go and get typically an adjustable rate mortgage to be able to afford a place, or a balloon note or something like that. So where you just paid the interest only or some sort of mortgage like that. An inside look, but back then, housing prices were so high as well. And then the one I'll leave you with before I go to this break, the last headline, America in ruins. America in ruins. It's over. It was over in 1981. We just didn't know it. We didn't know it before. You had a 5-fold increase in the S&P 500, an 8-fold increase in international stocks, 11-fold increase in international small. We just didn't realize it was over. We needed these publications to tell us that everything was over. But all is different now. It's always something different. Go watch my video out there. That's the whole point of that video. I'm too old for this. The whole point is to walk through history and give you a reminder about how bad things have been and how there has always been something to be absolutely petrified about. They got another article in The Economist about the new nuclear era. And it's all about how, all this proliferation reflects a weakening of the moral revulsion that restrains the use of nuclear weapons. This is a direct quote from the article. As memories of Hiroshima and Nagasaki fade, people fail to grasp how the detonation of a small battlefield weapon of the sort Mr. Putin might lob could escalate in a tit-for-tat annihilation of entire cities. Yeah, it's the stuff that I heard in the 1970s, stuff we heard in the 1960s. If you don't remember that, go back and look at the headlines. It was absolute fear. And people were petrified. And I'm not Pollyanna saying, nothing bad will ever happen in the world. There's always bad stuff. But you look at this and you go, whoa, wait a minute. If we got a guy that might actually be willing to do something like this, they get attention or the attention of other people. And it's just, the reality of it is that countries look at somebody like this and they go, whoa, wait a minute. And I don't know where it's going to end. I really don't. I can't say anything, but I think it helps to understand that we have been through very, very similar types of things. They always say that history doesn't repeat, but it rhymes, and it sure does. But if you look at markets around the world right now, and you look at pricing of stocks, international value stocks, you talk about markets being way down, right? Oh my goodness, like 20%, right? Almost 20% for the S&P 500. About 18% negative return as I speak right here. And you guys, areas of the market down 15, 20%. But international value stocks, and you're right over there in the other side of the pond, they're down 3%. Yeah, they're down. And value stocks, dang, your U.S. small value stocks down 5%, but it's like, wow, okay, so that's kind of a, that's noise, as we call it in the investing world. A 5% move is noise. You can have 15% moves in one day. And these areas of the market, like international value, they're still only selling for 94 cents on every dollar on book value. 94 cents. They're selling for less than the assets of the company. Small value, it's $1.09. That's it. Emerging markets value, 81 cents. So you look at, and it's even lower than that because that's using end of the quarter data right there. And of course, because, you've had some recent volatility, it would be even lower than that right now. So in essence, it isn't even as low. It's even lower than what I'm talking about. So you look at the pricing and go, wow, the markets are they're displaying the thought process that things are a little bit challenging right now. So they're not sitting at lofty prices as if everybody's oblivious to the things that people are fearful of. And the reality is that so many of the headlines that I'll bring out here on the show from time to time, you look at it and go, wow, we had that same exact headline 40 years ago? We had those same headlines. We had the same prognostications 40 years ago? Yeah. Now, I'm not saying it's exactly the same. It never is. But the reality of it is that these things happen over and over again. And what we do as investors, we forget. We forget how we come out of these things. And we go into, and I love what Michael says, that we go and make a mistake that's a permanent mistake based on temporary conditions. And the reality of it is, if all this stuff is true, if we look at this and we go, wow, you know what, maybe our growth rate isn't as good as other areas around the world, that's when change occurs in Washington. Either by a current party changing, and I don't know if that I see that, but more likely an election, because, as a matter of fact, the economists, they were actually talking about how it's looking pretty likely that there'll be a sea change in the fall. And, they're not known as being a really conservative publication by any stretch of the imagination. Let me just put that out there. So the reality of it is, when things don't go the way we like them to go, it'll be either companies that are making changes, and we're seeing some of that. Maybe there's some headlines that I'll share with you regarding that. Some things I've said in past weeks, we're actually starting to see the evidence for now. It's actually coming out.